Hello there, Dana here with your Thursday options trading video. Today I'm going to demonstrate two different trade opportunities that presented itself on SPY, the S&P 500 ETF, starting with the gap fill up. You know this strategy, we've demonstrated before. So on Monday, March the 31st, SPY gapped down, and on your screen you see SPY on the daytime frame. You know what that means. Each candlestick represents one day of price data. So on March 31st, SPY gapped down to an open price of $549.82. You know what that means when we say a gap down, that the price opened lower than the price of the previous trading day. Specifically, the low on Friday was $555.07. We gapped down about $5.25, therein creating a potential trade opportunity for the gap fill up. This trade suggests that the probabilities are SPY will increase in price to fill that gap. Again, $5.25. So now I'm going to drop down to the 30-minute time frame. Same information from the previous screen, but broken up into 30-minute candlesticks to show how the trade unfolded. So at the open on March the 31st, you have the gap, the 550 call expiring on April the 3rd, sold for approximately $628 per contract. So Dana, why the 550 call? As we've talked about before, your probabilities of a profitable trade are better if you purchase a strike price that is in or near the money. So this 550 call is in between the price of SPY at open and your eventual target. Throughout the day, SPY continued to increase in price, and look what it did. It filled the gap. And when SPY filled that gap, that same contract was selling at approximately $1,001 per contract. You can do that math. You're in profit over $373 per contract, or over 59%. But let's keep going. So that was a call contract that I just demonstrated for the gap fill up. But we also had a put opportunity in SPY this week. So I'm going to show you that now. This is the bearish engulfing strategy, and you've heard us talk about this before as well. On your screen, we still have SPY, the S&P 500 ETF, this time on the quarter time frame. Yes, the quarter. That means each candlestick represents one full quarter or 3 months of price data. So Quarter 1 of 2025 gave us the signal, a bearish engulfing. How do we know it's a bearish engulfing candle? The highest price of that candle and the lowest price exceed the highest and lowest price of the candle immediately to the left. So for this particular strategy, we have the signal, but we also need confirmation. Confirmation for this bearish trade would be if the new quarter, meaning Q2, opening on April the 1st, opened in between 50% or the low of our Q1 candlestick, $546.87. And what is the target? The first target would be the low of that quarter candlestick. There are other targets for this trade, but this would be the first target. Signal confirmation target. You can determine all of this before entering the trade. So let's see what happened when the quarter opened on April the 1st, where I'm going to drop down to the day time frame, same information as the previous screen, but instead of each candlestick representing a quarter, each candlestick now represents one day of price data. You can see the opening of the quarter much better this way. So the quarter opened on April the 1st. In between our confirmation. So according to these rules, I purchased the 555 put that expired on April the 11th for approximately $602 per contract. Again, why the 555 put? Because I always purchase a strike that is in between price at the time of entry and my eventual target. By purchasing a strike that is in between those two numbers, I increase my probability of a profitable trade. And why a put? Remember, this is the bearish engulfing strategy. So probability suggests that when you have a bearish engulfing candle, price will retrace to the low of that signal. So that's why a put worked here. So let's see how this trade unfolded. April the 2nd, you see SPY continue to increase in price. Didn't bother me because I had time on the contract and it did not violate my stop loss. As we know, Stop losses are very important because trading is about probabilities. There is no 100% strategy. You have to have strong stop losses in place to help preserve your capital. But still, I'm good here on this trade. I have a good strike price and I have time. So even though SPY increased in price, I held on to the trade. Let's see what happened on the next trading day. Look at this. SPY gapped all the way down below our target. So we met our target, first target, and then some. So according to my rules, I am out of this trade. All of the contracts, there was high volatility, lots of momentum. So you want to take advantage of that. The same contracts were selling at this point at an average of $1,370 per contract. You can do that math. Based upon that trade, you're up over $700 per contract for over 127% return on investment. So let's combine your two successful trades, your gap fill up as well as your bearish engulfing. Let's combine those. You're up over $1,100 in profit. Or actually, that's over $1,400. My math is wrong there, but over $1,400 in profit for over 90% return on investment. The takeaway for you today is to not be biased about what direction the trade is going to go. You want to identify the signal and trade that signal. If there is a signal for a call, trade it according to your rules. If there's a signal for a put, trade it according to your rules. Be disciplined and follow your signal confirmation target. Choose a strike that is in or near the money and take your target when it's hit. Questions? Let me know.